Good afternoon, everyone, and welcome to another Fast Track webinar. I am Peter Benjamin, and I couldn't be more excited to moderate today's session. Before we get started and get to the meat of today's webinar, let's start off with a few housekeeping items. Today's session will be recorded and will be posted to our website in the coming days. I will be monitoring the Q&A. Feel free to ask questions, and I will do my best to weave them in. And finally, our 2025 calendar of in-person events is published and registration will be opening soon. Be on the lookout for more information. Before we jump in, a quick disclaimer. The views and opinions expressed during this webinar do not necessarily reflect the views and positions of ACUMA, its board of directors, its management staff, or its members. The webinar and its materials are presented as ideas of possible strategies regarding specific topics and do not represent any endorsements of the presenters, their firms, or the concepts they present. Today's webinar is being brought to you by Dark Matter Technologies. Joining us today is Bob Brandt, Senior Managing Director of Sales. Bob, welcome. Thanks for being here, and it's good to see you.
Great to see you, Peter. Thanks for the invitation. We couldn't be more thrilled to be a part of the webinar today and to be a sponsor with Dark Matter. Credit unions and the credit union mission has been a special thing for all of us. So thank you for the invitation.
Of course, and of course. Now, Bob, now I know you and Dark Matter Technology have long supported the credit union movement, and I know that you actually you and I have sat down and had long conversations about what credit unions can do to really improve in this market. So Bob, really in this market, as credit unions look to try to improve really a lot of things, but whether it's efficiencies or try to reduce cycle times, really with the idea of improving member experience, what are some of the innovative technologies credit unions can leverage to capture these new efficiencies?
Yeah, you bet. I mean, you're exactly right. The organization that I represent, Dark Matter, has been committed to the credit union industry for many years. I personally have been going to ACUMA conferences for the last 25 years. And one thing has been more important today than ever before, and that is credit unions are looking to be more efficient and more effective at delivering service to their membership. And in the mortgage space, how they can do that is to implement technologies that can help them do their jobs more effectively, do it quicker, do it faster, and do it with more accuracy and precision. And the great news is there's some great solutions in the mortgage industry that accomplish that very thing, many of which we offer at Dark Matter as well.
And trust me, I believe that. Now, one thing I love about credit unions is like when you work with a credit union, it's like Cheers, right? It's like everyone knows your name, right? And credit unions are really known for like that high touch, personal
Mhm.
service, right?
Yeah.
Doesn't the idea of innovative technology and automation gained from technology kind of reduce credit unions' ability to deliver that personal touch?
Yeah, at first glance, you would think so. You would think by automating a business task, they would be eliminating somehow the personal touch that comes with the service that a member service rep can deliver. But actually, the opposite's the case. What we're seeing is by automating the easy things, even some of the more complex things, credit union member service reps can deliver better service by focusing on the hard tasks, the exceptions, the difficult things. And so that's really been a mission at Dark Matter is to use our technology to aid the member service reps, the credit union associates to use technology to do their jobs better. It's not eliminating positions. It's not eliminating their ability to deliver better service. In fact, it's the opposite. It's helping them do their jobs better. It's helping them have the calculations done for them right up front. It's helping them to take in documents that are sent by members, have those documents automatically parsed, data extracted, calculations made, and exceptions and conditions brought right to their front doorstep, and do it in literally a matter of minutes. That's really the mission of dark matter, is to use mortgage technology and automation to develop kind of an exception-based workflow throughout the mortgage process, from origination through processing, closing, even servicing solutions are a part of our capabilities.
Now, it's, I guess this next question is really a two-part question, and the first part's really like that with them idea, what's in it for me, and really what can a credit union really expect from these type of initiatives when it comes to results. And the
Yeah.
second part really is, and I guess it's more importantly, that return on investment. As they look to invest in these types of technologies, what type of return on investment should a credit union expect?
Yeah. Yeah, great question. Certainly, the mindset has changed with credit unions and just in the mortgage industry as a whole. With a lot of technology options, really more than any time ever before in the mortgage industry, it's very important that credit unions and lenders as a whole take the time to evaluate those solutions, understand how they can fit into their technology stack, and make sure that the integrations are there to make sure end to end they're not left with great technology that's not integrated with all of your components. And more important, it's very important that they run through a return on investment calculation and demand that of their vendor. And whether that's a current vendor or a new vendor, really evaluating what is in it for the credit union as far as time savings, value savings, dollars and cents savings is really an important thing. At Dark Matter, that's one of the very first things we do in a sales process is show the system, but then immediately dig into what's the return on investment with the solutions that we offer. So I would encourage all credit unions to expect that of their provider at all levels across their technology stack.
Now, one of my favorite topics is AI. And AI
Mhm.
is one of the technologies a lot of credit unions that I talk to are considering today, right?
Yeah.
But many credit unions are concerned about really adopting an AI technology, whether it's because of government governance, compliance, or really security risks. Now, I know that dark matter is on the forefront of a lot of technology curves. Can you speak to how dark matter is leveraging AI solutions to manage and mitigate those risks?
Yeah, you bet. Thanks for the question. It's a great and very timely question in the mortgage industry as a whole. AI technology brings the promise of kind of the next frontier of technology and some new capabilities that can really move the needle if applied correctly. And that's the key. I think there's different types of AI, and it's not always very transparent to the lender what type of technology or what type of AI is being used. We're all very familiar with the chat GTPs of the world and the large language models. Those are generative AI programs. They create new content, they create new creative. And in the mortgage world, they sometimes can pose challenges for lenders if not applied correctly. We don't have time to get into all the ins and outs of it, but at this as it relates to underwriting automation and technologies in the mortgage space, it needs to be explainable to your regulators and to your internal auditing departments what these technologies deliver. As it relates to dark matter, just a brief plug, we use predictive AI across our AVA platform that's integrated with the Empower LOS and also sold separately. It automates the process of importing the documents, extracting data off the documents, and running the income, asset, and post-close verification process for a lender. An enormous advantage to lenders for streamlining their business. But it's not generative AI, it's explainable AI that delivers results that you can prove to your internal and external auditing departments, which is really, I think, Peter, the big advantage and the big difference for lenders to think about. So we'd love to talk more about it with any of you on the call. Please, at any point, reach out to Dark Matter, and we'd be happy to run you through what we do and how it compares to others in the space.
Okay. Well, Bob, thank you again. I truly appreciate your time today, and thank you again for sponsoring today's session.
Yeah, thank you, Peter, and have a great webinar, everyone. Thank you.
Appreciate it. Well, it's my pleasure to welcome today's panel of experts, two gentlemen who probably need no introduction. Rob Chrisman, owner of Chrisman LLC, and Michael Christians, Regulatory Compliance Counsel at Michael Christians Consulting LLC. Gentlemen, welcome to the webinar. Excited to have you both here.
Thank you, Peter.
Well,
Great to be here.
excellent. Now, Rob and Michael, if it's okay, I'd like to jump right in. Now, to start, I appreciate that you both bring two vital perspectives to this conversation. On one hand, Rob, there's really no one better in our industry than you to discuss capital markets and interest rates. And on the other, Michael, your insights into compliance have been trusted by ACUMA in our community for a very long time. When I think of the purpose behind today's webinar, a look back on 2024 and a prediction of 2025, and really what it could mean to our members, there's really no better experts than the two of you. So let's start with 2024 and really what a year has been. So, Michael, I'm going to start with you. From a compliance and really regulatory perspective, if you could, what were three significant changes from this year, again, in your viewpoint, that took place that our members really should have paid attention to?
Excuse me. Yeah, you bet, Peter. So the first thing I want to talk about briefly is reconsiderations of value. There's been a lot of talk about appraisal bias. We've seen some rulemaking and some guidance come out about reconsiderations of value, which, an ROV is not necessarily a new concept, right?
No.
Reconsideration is you're asking the original appraiser, the original preparer of the valuation report, hey, reconsider your valuation based on new information or different information. All we've done here really is kind of tied up some loose ends. So the two things I want to point out, we've got interagency guidance that went into effect in July. And this is really going to cover your portfolio loans. And even though it's guidance, it says that it doesn't require you to do any of these things. Take that with a grain of salt, right? You're going to have conversations with your examiners that are going to say, you really need to do this. So under this guidance, they want you to put together policies and procedures as to how you're going to go about notifying your members that they have the ability to make this reconsideration request, how you're going to communicate those requests with the appraiser, etc. Now, we take that one step further. Those of you playing in the secondary market space, it's not guidance anymore. They put very specific, they being Fannie, Freddie, FHA, put very specific requirements in place, very specific disclosure requirements, procedural requirements, etc. So I think we put, and correct me if I'm wrong, Peter, I think we put some information about both of these in Compliance Insights. So I definitely go back and take a look at that.
We did.
Yeah.
And I think, the moral of the story of this is similar to what we've done, what a lot of compliance things are. Correct me if I'm wrong, but it's about documenting your process, right?
Yep, 100%.
And unlike, like you said, reconsideration of value isn't a new concept, right?
That's right. That's right.
But now more so than ever, you now have to have a documented process. The thing is that now Fannie Mae and Freddie Mac have now chimed in, right?
Yep.
And now, if you sell in the secondary market and if an aggregator has their own point of view on it, you now have to follow their process as well, right?
Yeah. Yeah. I mean, we're essentially just trying to tighten this up because we've seen over and over and over again evidence of appraisal bias. And so this is one arrow, if you will, in your ability to combat appraisal bias is to really put some specific structure to this reconsideration process.
Okay.
Okay, number two, just very briefly, and this is really only going to impact your portfolio loans, but we've got a new category of qualified mortgages known as a seasoned qualified mortgage. And in order for a loan to qualify for seasoned QM status, there's some origination requirements that need to have been met. First lien loan, fixed interest rate, not high cost, things like that. But more importantly, over a 36-month seasoning period, the consumer has shown basically a good payment history. So those of you that have a significant portfolio presence where maybe you originated some loans that were kind of outside that specific QM definition previously, go back and take a look, because there is benefit to having a qualified mortgage versus a non-QM on your portfolio from a litigation perspective, from a safety and soundness perspective, from a compliance perspective, etc. So that's out there. It's available. Something to take advantage of if you can. And then finally, one more thing. It's not final yet, and let's knock on wood that it doesn't become final. We saw midway through 24, the CFPB propose a rule to significantly enhance mortgage servicing protections for borrowers, which is just going to put an incredible amount of additional responsibility on those of you that are servicers. We're talking about additional early intervention requirements. We're talking about elimination of a formal loss mitigation application and basically transitioning to a hand raise provision. Hey, I need help. And third, and I don't want to discount this, a requirement to translate or make available in English, Spanish, and 5 other languages all of your servicing communications. Okay.
Wow.
That's huge, right?
That's huge.
So let's hope, again, that was a proposal. The comment period is closed. Let's hope calmer heads prevail and there's significant changes before that goes final, if it does go final. So
Now, just out of curiosity, on that,
yeah,
the 5 different language,
yep,
are the 5 different languages prescriptive, as in the CFPB has outlined what those 5 other languages are, or is it strictly based off of the geographic footprint that you're in?
yep, excellent question. 5 additional languages at the credit union's election that covers a significant majority of your borrower population.
Okay.
Yep. So it's not going to necessarily be the same 5 for everybody.
Okay. So, I mean, that could cost, similar to TRID, kind of going back to that, a significant cost increase
100%.
just to obtain that type of translation type services.
Yep. 100%. Absolutely.
Okay. Okay. But of course, as we look ahead at 2025, new administration, who knows what could happen.
Yeah. And I think between Rob and I think we'll revisit what's next, right? Yeah.
Yeah, I think so. I think so. Okay, Rob, turning over to you. Same question, but slightly different. Again, you're focusing on, capital markets, interest rates, what were 3 things that occurred this year with the secondary market or really interest rates that took you by surprise? And I'm gonna add that the second question of and why.
Well, first of all, Peter, thank you for having me.
Of course.
And Michael, good working with you on this. The at the risk of stealing some of my thunder for later in the session, I would say the primary thing that happened was the election. Probably the second most important thing that happened was the election. And if I had to say the third would be the election. Uh, if you look back to 2020 and 2021, and obviously every day that goes by, the more those years are in the rear view mirror, right? So we're going to be talking about them for a while and how the Fed reacted to the market environment. And of course, the Federal Reserve doesn't have a crystal ball any more than I do, or Peter, or Michael, or anybody really. The Fed and the Federal Open Market Committee was dealing with the information that they had at the time. And there was a tremendous amount of uncertainty. And because of the pandemic and the measures that we took because of the pandemic, the economy was in danger of shutting down. Not only just toilet paper, but all kinds of things. And so,
You're not stocking up now, are you?
no, but it was such an interesting study in psychology, right? Just the psychology of the public, and everybody was watching Tiger King and buying toilet paper and whatever. But the Federal Reserve did what it thought was right at the time. And we can't really go back and judge the Federal Reserve and its actions, pro or con. We can learn from it, however. And so since those years, we've been dealing with the aftermath. And of course, as we knew that they would, rates have moved higher. Rates were abnormally low during that time period. Rates have moved higher. And for the typical lender out there, 2022 and 2023, and to some extent 2024, were rough years to make a buck, frankly, in residential lending. The MBA, which does a study of banks and credit unions and IMBs, showed quarter after quarter after quarter of companies losing money. The companies that made money tended to be the owners of servicing, so they had that servicing income. But throughout the year, throughout these last few years, companies have been cutting back, whether it's in personnel, whether it's in technology, just in general overhead. Well, through this period, credit unions, I would say, have been, and especially this year, have really shown the position that they have in the marketplace in a very favorable way. Credit unions have this wonderful thing called membership. And when you talk about fluctuations in interest rate and what the Fed is doing and what might happen and what has happened and so forth, the credit unions have kind of been the steady eddy in the group. They, I would say, and credit unions much better than I do, Peter, but from what I've seen, credit unions are it's fine what interest rates are going to rates are going to do what they're going to do. But you know what? We're here to take care of our members, and we want the products that we need to be able to take care of our membership. And so, Fannie Mae is doing what it's doing, Freddie Mac is doing what it's doing. Interest rates have moved up, and now they've leveled off here, and they could be leveled for quite some time. But throughout all of that, the credit unions have just continued to help their members, whether it's conventional conforming product or FHA or portfolio product, whatever it might be. They're there for their members, and they have tended to play to their membership much better than, say, an IMB might or a broker might. Credit unions have competitive advantages that they are using to increase their market share. And I think that's one of the big things that I've seen over the last year or two is an increase in that. They're playing to their strengths. And why not? They do have strengths. The second thing that is I've seen happen is with regard to the question about the agencies, Fannie Mae and Freddie Mac, namely. And we'll probably get into this in a little bit, but really, as the election became, the election outcome became certain, it's like, all right, during the previous Trump administration, what was going on? Well, Fannie Mae and Freddie Mac were placed under conservatorship in 2008. And if you think about it, anybody who's been in this business 16 years or less has never known Fannie Mae and Freddie Mac not being in conservatorship. So it's an interesting situation. the first step in releasing them from conservatorship is or was letting them keep their earnings, which happened during the Trump administration. And so the question came up once the election took place, what will happen next? Well, the next step is to actually release them from conservatorship now that they beefed up their net worth. Fannie Mae's net worth is about 90 billion. Freddie Mac's is about 56 billion. So they do have some financial wherewithal now. And so what steps will the new administration take in promoting the release of Fannie Mae and Freddie Mac from under the government? And then the third thing, the big surprise, and it's not so much of a surprise, but kind of treading on Michael's turf here somewhat, but really what's going to happen with regard to the regulatory situation. And with the new administration coming in, who really showed that it is not exactly anti-regulation, but definitely taking the foot off the regulatory pedal, as it were, during the prior time that they were in office. What will happen next? And so I think we'll be talking about that then. But so Peter, in answer to your question, the first thing I've seen this year and last to some extent is credit unions increasing their market share and increasing their worth to borrowers and to members. The second thing is interest rates. Interest rates are going to do what they're going to do. They've done what they're going to do, and so be it. And then the third thing is what's going to happen in the regulatory issue, and just a lot of question marks regarding those issues.
Okay. So next question. I mean, Rob, as you said, there was an election, and this is really a question to both of you. So with the new administration on the horizon, and again, from both of your perspectives, how has the industry already changed? And really, what can we expect to see in the coming years? Now, Rob, we'll have you pick up from where you just left off. We'll have you start with this question again. What can we expect in the coming years? How has the industry already changed? Rob, we'll start with you.
So I think it's important for folks to remember that the President of the United States does not set interest rates. The president's policies can impact interest rates. Congress doesn't set mortgage rates. The Federal Reserve doesn't set mortgage rates. Mortgage rates tend to react based on the policies of that and the world economy. Because, for the last few years, we've been talking about inflation. Well, the Fed can do what it can to help push inflation down, but all it takes is a shortage of cocoa or a drought in Kansas or a ship getting stuck in the Suez Canal, and suddenly we have a supply chain issue, for example, which tends to cause inflation. Leading up to the election, there was a lot of talk in the Trump camp about tariffs. We need more tariffs, tariffs with Canada, tariffs with Mexico, tariffs here, tariffs there. I think it's important for people to remember that someone has to pay for those tariffs. Generally speaking, tariffs are inflationary. And so it's all well and good for President-elect Trump to talk about, well, I want lower interest rates. We need lower interest rates. But frankly, if the policies lead to higher interest rates, we have to be ready for that. And I think it's important for credit unions to kind of keep their knees bent. And there can be a lot of talk about lower interest rates. But frankly, if the policies would suggest more inflation, then typically that's going to lead to higher interest rates. So I think we have to be ready for that. But in general, the bond market is kind of taking a wait and see attitude here with regard to tariffs and the other policies that might be implemented. Now, remember, despite what you might read in the press, the new administration doesn't come into office until the end of January, right? And so the markets tend to be more forward thinking and looking ahead at what might happen. And so right after the election, rates shot up. All right. because of this tariff question about what that might do, what the tariffs might do to inflation. So rates shot up, they've come down a little bit, but they've stayed at a relatively elevated level. Mortgage rates, I don't know, give or take, might be 6.75 to 7.25, somewhere in there for 30-year fixed vanilla type product. And we could see those interest rates for quite some time, especially if the Federal Reserve takes a wait and see approach to the economy. It's generally expected the Fed will raise overnight rates next week, and then they may just sit on their hands for a while. And so if you like interest rates, especially mortgage rates where they are now, good. You might love the next, 3 to 6 months. And so I think we have to be ready for that. And then the second thing, as I said earlier, is what might happen in the regulatory environment. Michael's going to talk more about that, I believe. But really, it'll be interesting to see what happens. I'm going to voice my opinion here somewhat in advance of Michael jumping in, but I would say that credit unions, banks, independent mortgage banks, broker shops, over the last 10 or 15 years, we've all spent a tremendous amount of money bringing ourselves up to speed in the regulatory environment. And, right after the election, I started receiving emails. Hey, are we going to go away? Is TRID going to go away? Is TRID, are we going to, is the new 1003 going to go away? Is, LO comp, is it going to be, Katie bar the door? And I had to tell them, no, that would actually not work to our advantage as an industry to do away with the things that we've spent so much money and time and effort in implementing and understanding. So my 2 cents. Anyway, I'll turn it over to Michael.
But real quick, and sticking with you, Rob, quantitative easement. Do you see the government going back to mortgage-backed securities, buying them up, and holding on to them?
Well, they've been holding on to them. The runoff, they've seen runoff because obviously loans refinance
Right.
or somebody sells their house and the loan pays off. I don't see that happening personally. I think we've learned some hard lessons over the last 4 to 5 years, and I don't think they want to repeat that necessarily. I think that if you look at, and we're getting into demographics here a little bit, but there's tens of millions of people who want to either buy a home or maybe they don't own a home now, or maybe they want to move up. And so the issue isn't so much interest rates, because if you were to lower interest rates, that would just create more of a feeding frenzy, especially in the starter home market, which is already overheated. It's hard to find starter homes. Builders aren't too interested in building starter homes. And so even if rates went down to zero because the Fed stepped in and were buying every security that was issued, frankly, if you can't find a home to buy, even if interest rates are zero, you can't find a home to buy. And so I think rates are where they are. I think the Federal Reserve is comfortable with rates where they are. I don't see them needing to step on the gas pedal with regard to buying securities, driving up prices, driving down rates at this point.
Okay. So you're not buying into the whole silver tsunami idea in Buffalo and Pittsburgh? No. Okay. All right, Michael, to you.
So I don't know that I could agree with Rob more when he said, the three most important things were there were an election, or there was an election, right? Regulatory compliance has always been, in my experience, my crystal ball is pretty cloudy. Well, at this point in time right now, it does me no good. It might as well be shattered into 100 pieces, because I don't know what is in store. But let's talk about it in the context of elections have consequences. And let's look at this from the three branches of government perspective. Okay. I want to start with Congress, because I think Rob made a very good point. So we are going to have a Congress where the Senate Republicans are going to have a 3-seat majority, if I remember correctly, and House Republicans are going to have a 6-seat majority, I believe. So there's a couple things that Congress can do with that majority. First of all, immediately, they've got some more flexibility under something that's called the Congressional Review Act. And what the CRA does is it allows Congress to overturn an agency rulemaking within a certain period of time after it's gone final. So this next Congress that's coming up in January will be able to take anything that has gone final from right around August 1 of this year until when they take office, that they'll just be able to pass a resolution saying, nope, agency, go back to the drawing board. Resolution's got to be signed by the president, but the incoming president, also a Republican, right? So that's a pretty powerful tool for Congress to have. I also find it very interesting, and this is something that Rob alluded to. I think it was Elon that said, I don't know, maybe a couple weeks ago, well, let's just get rid of the CFPB altogether. Okay, there's so many other agencies, there's so much overlap, let's just get rid of it. Well, it doesn't quite work that way. CFPB was put in place by the Dodd-Frank Act, so it requires congressional action to basically eliminate it, and there's zero appetite for that. There's zero appetite for it. To Rob's point, how much time, money, blood, sweat, and tears has been put into TRID, HMDA, 1033 coming up, 1071, small business lending, data collection. The list goes on and on. I think the most you see Congress willing to do as far as amending Dodd-Frank and doing something with the CFPB is maybe going from a director, a sole director, to maybe a commission, and addressing this question about, are they subject to an appropriation, right? Instead of going right to the Fed for their money, Congress has to write the check. So I think that's where we're at from a legislative perspective. From an executive, obviously we've got a new president coming in. Traditionally, what happens January 20th on Inauguration Day, incoming chief of staff sends a message out across all of the agencies, pencils down. Stop what you're working on. We're going to look at everything. So I think anything that is in the hopper at that point from a proposed perspective doesn't happen, okay, until the new CFPB director, whomever he or she may be, decides what action they're going to take.
It's not just CFPB, it's FHFA, you name it.
100%.
So we're talking junk fees, new credit score models. The list goes on.
Yep. Yeah. It is going to be a sea change of the environment that we've been in the last 4 years with this drumbeat coming out of the White House about junk fees and consumer protection, and a CFPB director that was willing to push the edge of the envelope. And we're going to see that completely shift, in my opinion, in the other direction. But to Rob's point, this stuff's not going to go away. It's just going to dramatically change, if you will. The other thing I want to talk about is, and this is probably the most consistent, and Peter and Rob, I'd be curious as to your thoughts as well. In my relatively short compliance career, I have never in my time seen the amount of litigation that we are seeing today against agency rulemaking. As soon as somebody puts out a rule, they're immediately sued, saying they exceeded their authority, whatever the case may be. Litigation is going to continue. I think some of these agencies taking a less strict approach from a regulatory perspective maybe choose to stop defending some of these rules and just say, yeah, we don't necessarily disagree that the previous body maybe overstepped its statutory authority, right? So it's going to take some time for all of this to kind of come out in the wash. But suffice it to say, we're entering a period where we're going to have agency leadership all across the board that is more institution friendly, and maybe not so specific on some of the things that they're trying to accomplish.
Appreciate that. Last question before I give you guys final thoughts, and I'm just looking at time. As we look ahead to 2025, what are some of the, things, our members should focus on? Michael, we'll start with you.
Nuts and bolts. Here's going to be my suggestion. Until we know what we don't know right now, it's business as usual. And what I mean by that is make sure you're making your updates to your various thresholds from an origination perspective for 2025. Make sure that you're moving forward with your implementation plans until you definitively know that something has significantly changed, right? But then just be willing to take a wait and see approach. This transition from tri-merge reports to bi-merge reports, previous FHA or FHF, excuse me, said we're going full steam ahead fourth quarter 2025. Is that going to happen? I don't know. Your guess is as good as mine. So we've got a little bit of time period to go through where we kind of have to take a wait and see approach, but be adaptive, be reactive, and be ready to turn on a dime, if you will.
Okay. Rob.
Michael summed it up. The only thing I would add, and all of that made total sense, in the secondary markets, capital markets, when you talk to capital markets folks, such as myself, they never make they never make a living based on predicting where interest rates are going to go. They make a living based on hedging a pipeline day after day, week after week, using the same technology, or not so much the same technology, but the same methodology, and doing the same thing, taking it one day at a time. And they don't predict interest rates. And I've seen companies go under where the CEO or owner says, "Oh, I think interest rates are going to do this," and they do the opposite, and away goes the company. I just don't see. I think, going back to Michael's point, keeping their knees bent, just being prepared, but continuing to do the things that credit unions are good at. I mean, what can you do? You can't say, well, I think TRID is going to go away, so we're going to change the way we handle the regulatory environment. Or I think interest rates are going to go down, so we're going to do this. That's just a recipe for disaster. So just keep doing what they're doing, and just be aware of what is happening and why.
Before we close out, and you already kind of sort of did it, but any final thoughts from either of you? No?
I'll just say, buckle up. It's going to be an interesting ride in 2025, and I'm sure we'll have plenty of more of these types of conversations.
I was looking for something poetic, Michael, and you gave it.
Buckle up.
Buckle up, yeah.
I wish I could think of a haiku to match that. No, it's important, and I tell audiences this when I go to speak. I mean, the fact of the matter is, people want to own homes, and members need financing, and whether the industry does $1 trillion or $1.5 trillion or $2 trillion or $2.5 trillion, somebody has to do those loans, and it may as well fall on the shoulders of credit unions across the nation to keep up their market share and help their members, and just keep that in mind. So,
okay. Well, thank you
parting
very
words.
Thank you very much. Well, gentlemen, I'm looking at the Q&A. I'm not seeing anything come through. Thank you both for spending time with us this afternoon. Truly do appreciate it. Thank you very much again.
Very
Thank you.
welcome.
And to close out, once again, thank you to Bob Brandt and Dark Matter Technologies for sponsoring today's webinar, and to Rob and Michael for their valuable insight, and to all of you. Thank you for attending today's webinar. Your time is valuable, and we appreciate you spending the better part of an hour with us today. We hope you enjoyed today's session. We appreciate that really 45 minutes isn't nearly enough time to cover everything on this topic. So if you want to learn more and can continue to fine-tune your knowledge, I would recommend attending one of our upcoming events or listening to one of our podcasts, where you'll find that we'll continue to expand upon this topic and much, much more. Head over to www.acuma.org or our community page for more information on the latest updates on everything happening over at ACUMA. Until next time, be well, my friends.